everybody. We are excited to unveil our newest house view. This time we covered Q4 2024 review and the 2025 outlook. I'd like to start with the discussion of what happened the last quarter in terms of indices. So, we saw a continuation in a global but notable rise in interest rates across the world. We saw the 10-year Treasury in particular went from 3.6 in September to 4.4% in November. Mag 7 continued solid growth, but, when we're looking at things like materials, they were some of the weakest in the sector. And we had GDP put her along at 3.1%. Employment's been solid. The big thing is, what ultimately a new Trump presidency will mean in terms of tariffs and deportations. But that's coincided with a decreased amount of regulations, and people are definitely bullish on tax cuts as well. So last 2 years back to back, we've had plus 20% growth in the S&P 500. Who knows what 2025 will bring, but that's kind of the backdrop of what we're seeing right here. And Tim, with that, let's kind of get into our outlook and in particular how we're framing the debate on a bunch of indicators going into this new year.
Yeah, we use that phrase, frame the debate, a lot. And, it's because we come at this with enough humility to know that we don't know the future. We lead in this report with the famous quote from John Kenneth Galbraith, one of Kennedy's best and brightest, which is that there's two kinds of forecasters. There's those who don't know the future and those who don't know they don't know. This morning I was reading David Einhorn's kind of review and outlook. He's the famous hedge fund manager, with Greenlight Capital. And he wrote some similar stuff to what we wrote, which is that, look, there's never been more policy uncertainty. And they really have very little confidence on their macro outlook overall and their market view overall. He's a guy who is basically a value guy who's used a value arbitrage strategy. And those kind of guys struggled last year, right? Unless you were long the Mag 7, you were going to trail the indexes and trail them by a lot. And that's what you see with the best and brightest of the hedge funds out there. They had more like 10% returns last year. Einhorn was even lower than that. The median stock in the S&P was up 10%. A third of S&P names were negative. So the breadth of performance and the breadth of earnings really wasn't that great. It's just that the earnings growth at the top of the pyramid with all of the kind of quasi-monopolies that we now have dominating the markets in this economy, it's pretty tough if you're not in that group. So our outlook this year starts with housing. When we talk about the economy, we always start in talking about housing. We talk a little bit about lending. We think lending and where we are in the lending cycle might be underappreciated in terms of potential upside to this economy and markets. And then we're also, as Einhorn did, we talk about policy uncertainty, the biggest policy uncertainty coming on the tariff side, but it's certainly also worth mentioning that we have such a secularly tight labor force that we don't really know what the impact is going to be. I hardly think it's going to be positive when we really get these deportations going. And then relative to the markets, look, it's the P and the E that matter, right? That's all that matters. It is the multiple that you pay and the earnings growth. So we'll walk through earnings growth. We'll walk through what we expect multiples to do. And then that big driver of multiples is going to be the confidence around AI. So let me start with housing and talking about the economy. Look, overall, there are some negative aspects to the economy. As you see in the chart that you've got there, we have built up a decent amount of inventory. Now, the fact is that this is new home inventory, and it's mostly isolated to the Sun Belt, and largely it's Florida and Texas. Most of the country, Danny Dayan used 80% the other day because most of the country is dominated by existing market. He used the quote, he said on our podcast the other day that, 80% of the housing market is basically frozen. It's not going to turn over. And that's important to consider when you think about how housing and housing prices are going to move forward. It's hard to imagine a meaningful downturn when you look at all of the accumulated wealth, all of the generational wealth transfer and the lack of supply that's out there. So look, if we go way over 7%, or stay over 7% on mortgage rates for a period of time, housing is going to continue to be soft, but pricing in housing probably moves higher. Look, everybody obsesses over the inflation data, and they obsess over OER, owner's equivalent rent, and shelter inflation. And what you are seeing is multifamily in some of these MSAs, some of these cities getting softer, and you have new rents coming in. But there's also the argument that long-term OER is going to follow what house prices nationally do. And I would expect house prices nationally to be up again this year outside of a recession. It really does depend on rates, though, because if we do have rates move meaningfully higher, you're going to see, this is a good chart where, we are at near all-time highs in terms of residential employment. And if residential employment starts to weaken because the housing market becomes even more frozen, and you have even more new home inventory that isn't moving and pricing is coming down, builders' margins are suffering because of all the buy downs that they have to do, then I would, you could see a little bit of a softer housing market. But I hardly see a housing market that gets really weak and absolutely nothing that looks like 2008, 2009. One of the things that we think is interesting is that this has been a income driven, partly, driven by federal spending. The $8 trillion we printed, the $2 trillion of ongoing deficits, the largest deficits in the OECD. But it hasn't been a credit driven expansion. In other words, we are not late cycle when you look at household and corporate balance sheets and the bank balance sheets. The banks have plenty of capacity to lend. The banks want to lend. The question is, how much demand is there going to be for that lending? Just like with housing, I think the answer is going to be in interest rates, right? If bank lending is going to continue to be at that 9-10% range as the NFIB, the National Federation of Independent Businesses, as they estimate, lending will be soft. And it may not be late cycle, but it's not going to help us grow this economy. The fact that there is this capacity to borrow, because I think a lot of corporations just not going to pencil to borrow money at 9 and 10%. And then there's the policy uncertainty component of it. As we record this on Jan 22, President Trump has been the president for a few days, and there's already been some meaningful market gyrations on utterances that he has, or lack of utterances that he has on tariffs. What it looks like right now is we're going to start with these kind of punitive tariffs on Mexico and Canada at 25%. I'd be shocked if we're actually taxing Canadian oil at 25%, but we'll see. And 10% on China. But who knows? If this administration really plans on getting meaningful revenue from tariffs, then they're going to have to be more universal. Because what we saw in the 2018-2019 cycle of tariffs is that avoidance was massive, and that we didn't significantly generate a lot of revenues. And then you also have the currency offset as the countries that are most likely to be targeted by these tariffs. You're already seeing much weaker currency, stronger dollar. That'll have a negative impact on the earnings side. So let me transition over to markets, and we'll start with earnings. Look, what's different about 25 and 23 and 24 is that in 23 and 24, expectations were pretty soft. Now you have expectations, and you have a multiple that reflects very high expectations, but you also have expectations that earnings are going to accelerate from here to do about 12% earnings growth versus 2024, and that really being back-end loaded. So you're hoping for some really much stronger economy. Well, not a much stronger economy, but a stronger economy. If you're going to do 17% growth, which is what's embedded for Q4, you probably need more than 6% NGDP growth, nominal GDP growth, and you're going to need a hell of a lot of margin growth. And margins are already at all-time highs. So the fact that expectations are where they are, that gives us a little bit of pause. I will say we're early in earnings season. Earnings season looks pretty damn good, right? The bank's earnings are going to be really great because NIMs are expanding and they are extending more credit. Again, The demand for that credit remains a little bit soft, but you see leisure companies, United Airlines. I just got off a United Airlines plane. I'm in freezing cold Pittsburgh. But they said demand remains really strong, and they expect demand and revenue per average seat mile, which is the metric the airline industry uses, to be very strong. So look, you are hearing anecdotally in these early conference calls from Q4, as companies start to think about their outlooks for 2025, they are seeing some greater demand. It's not surprising, right? We saw the soft data suggesting that post the election, demand for hiring is moving higher. The NFIB data has gotten much, much stronger. A lot of the soft sentiment data has gotten much stronger. We'll see the degree to which that translates into the actual hard data. The other question then is, what does the multiple do? Well, we're starting at a historically high multiple. We don't really use the Shiller Cape, but if you use Shiller Cape, if you use market cap as a percentage of GDP, or if you just look at trailing or next 12 months, we are at these historically high levels when at the same time margins are very high. So the question then becomes, okay, is there an ability for the multiple to expand from here? And to me, that is going to come down to, is earnings growth show up as strong as expected? And if not, then I would expect that both the earnings number won't hit the expectations and that therefore multiples should contract a little bit. But then the other side of it is really AI optimism, right? We always talk about AI, the optimism around AI as being sort of non-disprovable, right? There may be a digestion period here, though, where some of the expectations of this permanently higher level of productivity is being sort of mistaken for the fact that the reason why productivity is so high, the reason why return on invested capital in this economy is so high is because demand is so high. And demand is so high, not necessarily because of AI and technology, but just because we've spent so much more money running much higher deficits than the rest of the OECD. Not only do we print the most money, but we also are continuing to run the highest deficits. That alone drives productivity because it drives utilization. So anyway, those are kind of our very quickly run through points about what we see in the economy, what we see on earnings, and what we see in the market multiple. On the AI side, it really is going to come down to, are we at peak sentiment on AI? Or is there going to be a consumer app that comes through that really wakes up the investor base even more to the promise of long-term productivity growth being driven by AI? We will need that in order to maintain this multiple through this year and in the future. So let me turn it over to you, Drew, to talk a little bit about commodities and what we see internationally.
Thanks, Tim. So commodities, we had one of the most range-bound quarters we've had in history, really. It fluctuated from $71 a barrel to $81 a barrel. We're looking at an OPEC that is delaying lifting its production cuts again. This has happened a few times now, but its unwinding is expected to go from April and continue all the way through 2016 or 2026, whereas before most of the cuts were supposed to be done all this year, 2025. We saw fluctuation in a lot of different places. So demand just dropped in Asia. So we saw a decline in liquefied natural gas rates. But then when you look at, Europe, there was a substantial drawdown, and then you saw LNG prices just spike as a result. There has been some interesting analysis came out of the EIA that when we're talking about a decline in rig counts, we have talked about how there's been a lot of CapEx underinvestment from the majors in terms of new rigs and everything else. But AI productivity has really increased, what a rig is able to output as well. So as a result, we've seen 18% of the decline in active rigs across the board in the three major regions of the United States oil exploration, which, you're looking at the Bakken, Eagle Ford, and Permian. Gold, great year for gold. The best year in 14 years, was up 25.5% in 2024, outperformed pretty much all the other asset classes. Largely due to, we've had some inflation, but then there's also a year of elections. So this has been the peak year in human history in terms of elective governments in terms of people turning out for representative governments. We saw elections in the UK, we saw elections in the US, we saw elections in India. Globally, there was just a lot of elections, many of them being very turbulent, and therefore gold became a great hedge. We've also seen central banks increasingly comfortable with having gold exposure. So any offset to gold would be a change in monetary policy if Chinese or others decide that gold is no longer something they want in their wheelhouse.
It's worth saying, Drew, that we did predict this year in our variant views piece, our 10 variant views, that gold would be up by more than 20% in 2024. We haven't written that piece yet this year, but I would expect gold to have an excellent year again, because as you say, the odds of some kind of austerity really being embraced in an era of ever-growing populism is pretty damn unlikely.
Pretty unlikely. So yeah, not saying wealth theft is permanent gold bugs, but we were right on this last call, and hopefully this year as well. Copper, it started 2024 on a very strong note. What's really led to the demise of copper, or I should say the decline in the second half of the year, was really a slow in China. Long term, we think that factors like, more investment in wind and solar, which are copper-intensive renewables, but also just electricity across the board as the global south increasingly electrifies. We think that's going to increase the demand of copper. It's just a lot of that in the short term was offset by China, and particularly some weakness in their housing sector. Europe, had a modest recovery this year. Year over year, economic growth was a tepid 0.5% in 2023. In December 2024, we saw that annual inflation was 2.4%. So, yeah, growth was better than 2023. Inflation still kind of between that 2 and 3%. And that's really down from its peak of 10% or over 10% in October 2022. So there's been a lot of disinflation in Europe. The actors in Europe that have done really well are, what we used to call the pigs. So Portugal, Italy, Greece, Spain, and then it's kind of Germany and the UK that are really slowing down. China grew at 4.9% in 2024. They had a goal of 5%. We can get into a lot of reasons why people are suspect of some of the metrics coming out of China, but ultimately they did grow because they had a ton of stimulus. That stimulus came in the form of municipal debts. It came in the form of cuts in both interest rates and reserve requirement ratios. And they fully embraced direct payments to consumers as well. We're still looking at a real estate bubble that continues to slowly deflate. Exports were a big part of growth this year. And the Chinese coming into 2025 are really going to have their eye on tariffs and just generally a global decoupling between China and much of the developed West, in particular the United States. So anything on that side would really cut into their net exports, which are obviously remain a substantial part of their growth, despite the fact that their human capital is much more expensive than it has been previously. Japan, puttering along just fine. Consumer sentiment is a little bit lower due to stagnant wages. Core CPI is expected to remain between 2.5% and 3% until the spring of 2025. But yeah, definitely a lot of business fixed investment has come in and is expected to increase, especially when we're looking at decarbonization technologies and ways to deal with their very pertinent labor shortages. India had a great year. Their big bearish indicator, I would suppose, is credit growth is really projected to slow down. And we've seen a growth in personal loans that have fallen as well. The economy grew at 6.8% in 2024. It's forecasted to grow by 6.6% in 2025. And, healthy balance sheets and government stimulus paved the way for the new year. In terms of our political analysis, we focused on conflicts, namely Russia and Ukraine. We framed debate on those, and then we also did Israel and the larger Middle East. Secondly, we focused on U.S.-China relations. Taiwan was a big part of that. And last week, we just talked about populism around the world. So that's kind of our geopolitical frame of the debate. Russia, Ukraine, we believe that we're in a situation where both sides can point to relative strengths based off developments on the ground. Ukraine has pushed further into Kursk, but at the same time, Russia has pushed forward in the east, taking a lot of territories in Donbass, Luhansk, and other regions, saddling the seaboard there. Likewise, we think that a Trump administration is really going to cut military funding to Ukraine, not in part, in whole. At the same time, countries seem to be more inclined to allow the Ukrainians to take part of the $300+ billion in assets that had been seized by the Russians to pay for military. That was supposed to be for post-war reconstruction, but that could be used now. It's anyone's guess how this plays out. Both sides have lost hundreds of thousands of people. So we're hoping that all these factors are catalysts for them to sit down and find some kind of lasting agreement, at least a ceasefire, as they work out some of the stickier issues. At the same time, we think that Putin is increasingly old, and he's kind of just saddled with just a few of his most loyal advisors, and at that point, you are in a echo chamber. He lost in Syria. The Russians pulled out of Syria. They look very weak on a lot of fronts. So is peace on any terms but a complete Russian victory? Does that seem acceptable to Putin? We don't know. There's a lot of reasons you could frame the debate the other way, that he wants this thing to continue to a very conclusive victory, and that he will intend to do that. Middle East is kind of similar in this regard, except that Israel, unlike Russia, is in its best geopolitical position, I'd argue, since 1967 war, the Six-Day War. They have taken out most of Hamas's assets. They've really taken out Hezbollah in Lebanon. They've kind of taken off that as a front, too. Syria fell. Assad in Syria fell. That has been a historic enemy of Israel. They have struck Iran directly, and the Iranian response has been really weak. And they just secured a major ceasefire hostage agreement. So that all looks very good for Israel. Countries around the Middle East, despite all the violence that's occurred, still seem like they are willing to continue the Abraham Accords and break bread and normalize relationships with the Israelis. What can keep the conflict going is if Israel, who now views, and the rest of the world views, Iran as a paper tiger, if they decide to make a more targeted attacks, if they decide to expand the war that way, maybe taking out nuclear facilities, who knows? That could really cause things to erupt again. And we think that there might be incentive for Netanyahu to do that, to end these wars conclusively, because whenever the wars are, he's going to have to face the music eventually on the October 7th massacres and the security standpoint that led to the collapse, I should say, of security. And he's going to want to do that in a position of strength, and he's going to want to find ways to cement his standing within Israeli society. China, U.S., Chinese relations. I mean, we've talked about tariffs a little bit, but we do think a big risk is a possible incursion into Iran. We have seen that the People's Liberation Army activity around Taiwan has really increased over recent years. It's been, really close to their economic zone within territorial waters. And we think that Xi might view a war, as something that could be very detrimental to his legacy if tariffs are increased, or if it leads to a complete decoupling of China from, countries in Europe, particularly because they don't seem to have the same negative relationship as the U.S. and China do. So if we push Europe that way due to a blockade of Taiwan, then China's got less trading partners. On the flip side, Xi does strongly believe in a one China policy. We think that, based on their military activity, but also the fact that he was just recently reelected, this might be a situation in which this is his best chance, and the best chance to take Taiwan would be in the next few years when you have crises around the world and the U.S. is completely preoccupied. And we seem to be more, isolationist as well. So if China does decide to take Taiwan, we envision it will be in the next few years. It could very easily be a blockade, and it might not necessarily be a full kinetic invasion. Elections. Yeah, it's just been a lot more populism all over the globe. 64% of adults around the world say their economy is in bad shape, according to a recent Pew survey. So, there'll be pros and cons. Obviously, we think that international institutions are really going to kind of go by the wayside. So cooperation on climate, human rights, migration, conflict, that's going to be more difficult. At the same time, more muscular posturing could lead to some benefits, especially in industrial policy, that most countries around the world have missed and feel that neoliberalism has really led to a decimation of their middle class manufacturing sector. Look at, the north of England or the Midwest of the United States, etc. So that could be the Billish argument of, more protectionist policies and more populism in general, is that it leads to, a resurgence of the working man. Whether that pans out, history oftentimes it hasn't, but we see a populist in Argentina who anyway has led to the end of policy paralysis. And at least on a budget size, Argentina seems to be in better shape. Annuities had a great quarter. It grew 30% year over year, Q3 2024. Q4 hasn't been fully updated yet, so the most recent quarter we're looking at comes from Q3. But, this Q3 marked the sixth consecutive quarter in which RILAs went up. It was a great quarter for FIAs, and strong equity markets also pushed traditional VAs up 16% year over year. Structured notes, it grew to $113 billion in 2024. When we're looking at a estimate from Cerulli Associates, it put advisor penetrations around 22%. So a lot more space for participation in the industry, but we've seen real growth in the percentage of financial advisors who are using structured notes across the board. When we're looking at predictions for 2025, estimate interest rates to remain elevated, which will protect funding levels. But, with changing market conditions, volatility and decreased call momentum can pose challenges as well when we're looking at the new year. Tim, that's what I have today. Anything else we should talk about, shed light on?
Yeah, I would leave it at that. It just say, Darius Dale, who runs a macro firm called 42 Macro. Everything that he says lately, he has started with the same line, which is the dispersion of potential outcomes is vast, right? It's not exactly his word, but that is the idea, that the dispersion of potential outcomes is really all over the place, right? You have very high expectations, you have very high multiples, and yet you have policy uncertainty that's greater than at any time in my lifetime, really, in the markets, right? You have a tariff policy that is going to be an experiment that is not tried since the end of World War II. You may have a immigration policy that has not been attempted in modern economic history. So there are a lot of unknowns. And then on the positive side, there is the unknown of just how much productivity we are going to get from AI, and when are we going to see the manifestations of that productivity. So there is uncertainty, and that's both good and bad. And with that, we would just say, have some humility, be careful. If you're a young person, of course you should be invested in stocks. But if you're an older person, getting maybe a little older than me, and I'm born in 1989, then now is the time to at least get a little bit more defensive. You've had 20% plus equity returns for 2 years in a row. There are a lot of great products out there and strategies to help you protect that money, continue to grow your savings without incurring the risk that I think this market at some point will price in when it comes to all the policy uncertainty and geopolitical risk.
All right, great. Thanks, Tim. And thanks for our listeners and subscribers. We hope you enjoy this document.